Did you see hot stock today? It has gone up 300% in the last few months.
Wow, that is a lot. But how expensive is it?
Well, it is Yahoo at 2,500 times earnings, but who cares about valuation? You sound like an old man. I am making money right now, and that is all that matters. No risk means no return.
Stop, in the name of love, before you lose your shirt. To be a super investor, you must be disciplined and focus on risk before returns.
If I only focused on risk, then I would not be up 300%. If I put my children's education savings and mortgaged my house to put it in hot stock, I would be able to retire by now.
Maybe so, but I do not think it is a good idea to do that. If I offered you a 50-50 chance to double or nothing your total wealth, would you do it?
Well, maybe not.
Of course. Super investors must think about risk before return. Super investors aim to become very wealthy over time, not in the next year. After all, if you focus most on minimizing risk, then the only way to go is up.
This sounds interesting. Tell me how I can become a super investor.
Well, super investors try to pay 50 cents for $1.
Now wait, this sounds too good to be true. Why would anyone sell $1 for 50 cents?
To tell you the truth, this happens frequently in the stock market. If everyone hates a stock, would you think of buying it?
No, because why would I want to buy something that everyone hates? There is always a reason people don't like something.
That is a good point, but sometimes, people hate a stock so much that they sell without caring how cheap they sell it. They sell based on emotions. When a stock falls out of favor, you may be able to buy a good business for a cheaper price.
But if everyone hates it, the stock might go down even more.
That is always a possibility. But if you have done your research, would you care if the dollar went from 50 cents to 40 cents? Of course not. The dollar has just become even cheaper to buy.
But if a company is cheap, doesn't that mean it is just more risky and volatile?
Well, super investors do not define risk as volatility. Volatility is volatility. Super investors define risk as the chance they will permanently lose money because their research is incorrect.
So in other words, risk is what?
Super investors think that risk means lost money that ain't never coming back.
Okay, but just 1 second, Mr. What makes you so special to see good investments when everyone else doesn't?
Super investors focus on valuation when others do not. Value investors focus on the business, not stocks they think will go up in the next 3 or 6 months. Super investors spend most of their time understanding and valuing businesses, instead of focusing on short-term fluctuations.
Okay, I think I understand value investing. But a raccoon down the street told me he became rich by day trading.
History and studies have shown that the overwhelming majority of people cannot successfully day trade over the long term. The raccoon you speak of could just be lucky.
Well, Mr. So-called super investor, how do I know that value investors aren't just lucky?
Value investors make decisions based on facts, logic, and valuation. The stock market in the short run may be a voting machine, but in the long run, it is a weighing machine. If a super investor is patient and his research is right, the market will eventually reward him for it. Unless hot stock can grow astronomically, my guess is it will eventually fall back down to earth.
Oh no. I should sell hot stock today. Even if it goes up after I sell it, the risk of permanently losing money is just too great.
Good choice. You are one step closer to being a super investor.